This is Alberto Pau, and we're going to present strategy 2, how to profit from market engineering with Taylor's book method. So let's get started. I hope you mastered and most importantly you started trading strategy 1. We're going to present a simple chart pattern recognition strategy that you can start using today. So without further ado, let's get on with it. Today we're going to cover, as I mentioned, the Taylor book method strategy. We're then going to have a detailed look at how to identify the patterns. We'll go through a practical exercise of analyzing charts, and we'll finish up with a summary and a conclusion. So, the Taylor book method strategy is a strategy that focuses on identifying zones where the market can be bought or sold with decreased risk. There is still an amount of risk, but the logic here is that you want to be trading the market in those zones where you can make a profit with lower risk. In other words, you want to stay away from the market scenarios where there is uncertainty and where there is a high amount of risk. Taylor also argues that the market is taken lower or higher to create buying or selling opportunities for market insiders, hence the expression market engineering. And we're going to go through this. When you put this to the test, you will see that this pattern holds. So, you may be wondering why is this happening? That's an explanation, but why this happens in general is not as important as realizing that this happens and profiting from it. In a nutshell, the logic of the Taylor book method strategy is that low market opens are often followed by higher prices and vice versa. And essentially what Taylor did is that he described the pattern that market engineering created. Today we're going to focus mostly on the pattern and how you can trade and make money from this. The market engineering pattern is divided in three main signals. The L day, or a buy day, or the long day, go long, where the market is taken lower on the open and providing a buying opportunity. We'll go into more detail in a second. Then we have the S day, which is the sell day, or the short day. The market would trade at or near the previous session's high, providing an opportunity to sell the previous long positions. And then we have the SS day, or the short sell day. And here the market opens at an extreme high, providing an opportunity to go short. So you don't have to be long, you just go short. Let's look at a chart so you can get a hands-on feeling for what we are referring to. We have here the S&P 500 as an example, but this strategy works on any asset and works extremely well on Forex. I've just chosen this chart because it really is an ideal example of buy days, sell days, and SS days. Let's get started. Okay, so we see here that in the buy day, which is the day to the leftmost, the market made a low very, very early in the trading session. Okay, so the market opened extremely low, okay, and opened lower than the close. So effectively, this is generating a buy day signal. Okay, then what happened is effectively the market rallied and ended up closing very close to the low of the buy day. But this is not too relevant for us. What happens next? Point 1 in red here, and we're moving on to the sell day, is we see how the market continued the previous day's decline and broke the previous buy day low of 884, going all the way down to 879. Okay, so according to the LSS technique, which is another name for the Taylor book method, there is a good chance that the market will rally above the buy day low if the buy day low has been breached, which is the case here. So this is a buy signal. Okay, we go long. Point 2 here, we see that on the same day, the market rallies past the buy day low, okay, which is what the book method would be telling us. And effectively what you would do here is, if you got in long at the point 1, so once we breached the buy day low, you could set your target profit just above the buy day low level. Okay, so what would have happened here is you would have caught a part of that rally, not all of it. Okay, or another thing you can do is stay long if you want to take a more aggressive approach to the market and effectively wait for the rally. Okay, which is what the strict theory of Taylor would say. So I'm giving you here two options. You can either take the conservative approach and just put a target profit slightly above the buy day low, because the theory is telling us that it is very likely that the market will breach the buy day low of the previous day. Or you can have a more aggressive and, if you want, stringent and exact approach and strategy to what Taylor states in his strategy, and in that case you would have stayed long. Okay, so we see here, point number 2, that the market rallies past the buy day low and reaches all the way to 912. Okay, so according to the LSS technique, the strict version, this generates a sell day. Effectively, you're liquidating your long positions. Then points 3 and 4. Okay, we see that the market opens bullish, okay, and breaches the previous sell day high. Okay, so we go from 912, which was the previous sell day high, to 913. So this generates a sell short day. Okay, so we go short. Okay, Taylor theory telling us that it is very likely that the market will correct. And indeed, the market corrects after reaching the low for the day, okay, and effectively generates a sell short day low at 891. Okay, so here we would have gone short at point 3, okay, and we would have closed out the short position at point 4 and made a very good profit. What happens then? We close out our positions at point 4, we're square, and then we see that the next day, okay, the market gaps up before breaching the sell short day low of 888. Okay, so you're guessing this by now. This generates a buy signal. And what does the LSS theory tell us? That it is very likely that the market will rally above the sell short day low. And indeed, that's what happens at point 6. On the same day, the buy day, the market rallies from the buy day low of 908 all the way to point number 6 towards the end of the day. To summarize, if the market heads lower on the open, that generates a buy day signal. If the market trades at or near the previous session's high, that generates a sell signal, i.e. liquidate your long positions. If the market opens at an extreme high, the short sell day signal is generated and you're gonna go short. Okay, so how do you go about practically implementing this strategy? It's very easy. You just have to look at how the market behaves at the open of the trading session. Okay, if either the market heads lower or higher compared to the previous day's high or low, then you've got a signal. Otherwise, you do nothing. And this is extremely simple. And also, if you have a busy life or you can only trade in the mornings or things, time constraints, this is really easy because it's a strategy that you can implement every day at the same time. It's not a strategy that, you need to be watching the screens, all day long. No. And you could actually take this a step further, because you can just put on your trades, for example, say early in the morning, and you know what the tailored book method tells you in terms of where the market is likely to go, either on the way up or on the way down, and you can just put your stop losses and target profits at those levels and not have to watch the position at all. Essentially, just let it run until either of the two are triggered. So it's really, really easy to implement. If you're looking for an easy strategy, you can trade, for example, say every morning before you go to the office. What's coming next? I've got a fantastic surprise for you guys. After a lot of twisting arms and kind of convincing, I've managed to have a very, very good trader that I know. He's been trading in the markets for 15 plus years. He's been coaching hundreds of traders at both junior and more experienced level. And I got him to come and share with us live one of his most profitable strategies. So he will be here with us on the call, sharing his strategies live. Okay? A hint, this is going to completely blow your mind. I know him. He's extremely, extremely good. He's been in the market, as I said, for a long, long time, and I'm very, very excited about this. It wasn't easy to convince him because he's not too much into the public speaking scene. But hey, he's going to be here with us, so I'll be talking to you in a couple of weeks' time with strategy number 3. Take care, and I'll talk to you soon. Bye bye.